Hey there, traders. This is Christian Fromhertz with Tribeca Trade Group with your weekend video. So this is actually the second video of this weekend. Yesterday, the major theme last week that I saw was money moving out of the U.S. and into Europe. So if you didn't get a chance to see yesterday's video, you can check that out on my YouTube page. I went into all the fund flows, which I'll touch upon in this video, but I'm not going to go out nearly as in much detail about the European inflows. Again, monster, dramatic inflows going into Europe ETFs, just a whole slew of them. So I'll touch upon that in a minute, but really that was the theme for last week. So I want to talk about what to watch for next week. I want to talk about the technicals, and I want to talk about more of U.S. markets than I did in yesterday's video. So first of all, what do we have next week? It's kind of quiet in terms of economics. Last week was a big week. We had the Fed decision. We had a lot of earnings last week, and we had Friday's jobs report, which looked pretty good in terms of what we were expecting. In terms of the last couple of weeks of economics, they were light, right? So the fact that we actually came in a little bit above, not huge, it wasn't a huge beat in terms of a jobs number, but the fact that it wasn't as bad as some of the economics that have come out in the last couple of weeks, I think is a good sign. I'm going to talk about a couple other good signs in a minute, but going into this week, we've got really nothing, I would say, for Monday that's going to move the market. Tuesday, we have the NFIB small business optimism, and if you remember months back, this number has been really strong. So we'll see if we continue with that trend. We also have the JOLTS job openings, and then later in the week, once we get, I think this is Thursday and Friday, 511 and 512, we get the PPI. So PPI and CPI, which will give us a good gauge of where inflation is at. We also get retail sales, which I think is probably the most important data point of the week, considering that some of the last retail sales report was weak, and a couple of the reports for the last couple weeks, not just retail sales, but things like ISM and durable goods have been on the weaker side. So this will be interesting, and we'll see if it will back up that stronger than expected jobs report that went out on Friday. Also, in terms of earnings, earnings season is starting to die down. Thank goodness. It's been a pretty crazy earnings season. We still have some important companies that are reporting next week. We have I see Nvidia is there. We've got a few energy companies reporting, but you could see that the number of names, we get Yelp that reports, Priceline reports, EA reports, Disney reports. So there's still a lot of big reports, but I'm kind of just getting excited that earnings season is starting to come to a close, because it's just very difficult to swing trade around earnings season. Option flow, which is what we watch on a daily basis, it gets very noisy trying to read into reports and a position that you may not want to take because they report earnings in a day or two. So I'm excited. I think it's also another one of those check the box on a good thing, because a lot of the company buyback plans have been in quiet periods. They've been turned off. So those machines are going to get turned back on, as Mortimer says. That will probably be happening, obviously, in some of the names that I reported a week or two ago. You'll start to see that back on, the money being added back into the market via buyback plans being turned back on. So again, a positive for the market. So what did we learn from last week? We had the Fed meeting. They're now pricing in. Let's see if I can bring this up as well. If I go to WIRP, which is Fed Fund Futures, which is not coming. There we go. WIRP, which basically shows that we are now pricing in, which I'm surprised this is 100%. I would think it would be like 97 or something like that, but we are now fully pricing in. Fed Fund Futures are fully pricing in a rate hike. Again, I would chalk this or check the box in terms of a good thing, meaning that the market is already pricing it in. There's not going to be any shock when they raise interest rates in June. The market is fully expecting it. A week ago, going into last week's Fed meeting, it was about a 70%. So it ratcheted that up from a 70% to now 100%. Again, market fully pricing in what's going to happen in June. So there will be no shock, no shock and awe when they raise interest rates in June. So again, I view that as a good thing. What else? So we'll talk a little bit about, let's talk a little bit about the technicals first, and then I'll talk about sectors. So last week, let's first of all bring up a chart of S&P, and we'll talk about the recent developments. I often see some people, they when they shoot these videos, they talk about what happens 3 months ago. I I think that's absolutely insane. So basically, we were very, very choppy last week, and then we broke out on Friday. So I was really, I sent this chart out several times, almost every day last week. We started the week. This is on the hourly bar. This is the value area for last week, and we started the week inside week. I think it was a great place to sell an iron condor. That's what I was advocating last week. Selling a call spread out here, selling a put spread out here, because once we start the week inside value, it's very difficult to get outside. And last week was a perfect example of that. Monday, we failed. Tuesday, we failed to break to the downside. Wednesday, or actually Thursday, we were upside and then downside, so all over the place in a very, very tight range. And then Friday, we checked. We tried to break out on in the beginning of the day, in the morning, right after the jobs report, and then right at the end of the day, we finally broke through. So what does this mean? It's nice to see us break above that resistance. We don't know. The French election is not out yet, but I think Macron does have a nice lead from what I saw, set 62 to 38. So that's a good sign. So futures are not open, and we'll revisit this Monday morning. But I think we're going to start the week in S&P futures above value, and that's a great place to start the week. I'd much rather start the week above value than like we started the week last week, which was right in the middle of the value area, and you can kind of see what we did, which is why I bring it up. So I think S&P is going to be the most cleanest looking chart in terms of the major indices. It is not overbought. So let me just go back to the daily chart. It is not overbought by any means. It's not a 70. You go to Nasdaq, which has just been the best performer by far. It is a little bit overbought. It came off of overbought levels last week, but it is still over 60. There's not much that I could really say in terms of this. Is it a little bit overbought? Yeah. The yellow line is way above the blue line, but notice how long we did this last time. There wasn't really much of a dip at all. I think if Nasdaq does come in a little bit and has a nice red bar or two, I think it should be bought, especially if I would love to see the price action dip below the yellow line on my chart, which is the 5-period exponential moving average, and actually get to the 20, because every time that's happened, it looks like it's been a great buying opportunity. So I'm not in the Nasdaq, especially with it over a little bit overbought here. If it comes off those overbought levels, I think a great place to get back involved. Let me just make sure I've got a couple of the moving averages here, which I think I had turned off. Let me turn on 50. Let me turn on the 200 as well, and we'll look at IWM next. Before I go to IWM, let's go back to Nasdaq. Let's just look at where this is going to start for the week. Also looks like it's going to start the week. Notice it was above, different picture than S&P. It was above the value area all last week. So again, I'm on the 1-hour chart. And it looks like we may start the week above value as well. Notice how small the value area is that is developing for next, or has developed for next week. Why is it so small? Because it's reflective of last week's value area, which again we traded in a very, very tight range. So really slim looking value area for the week, which makes it not that significant. Small caps different. So we talked about S&P. Getting above value area. Look at what small caps did last week. They kind of started the week right around the bottom of value. They got into value very briefly, then fell out. They underperformed just a touch last week. So I would be watching, basically 1400 in small cap futures. Notice that we took this VPOC out and reversed, which was a really nice signal, that purple line. So if you actually look at IWM, so I can give you a level, but basically 139.19, which we could easily get over on Monday, and I think I would like to be long. If we do get up there, I think it'll be a great place to maybe sell put spreads. If we get above that level, also notice on the daily chart that you've got some nice support that we bounced off of last week, basically 137.51. I think you want to be long small caps if above 137.51, and especially if we could get in the beginning of the week above 139.19. Great place, I think, if that happens to sell put spreads in IWM. So that's the major U.S. indices. Just a quick review of those technicals. Looking at which I also broke out in the newsletter. So if you're not if you're not a subscriber of Tribeca Trade Group, you can review all this. We put out a really comprehensive macro-based newsletter, and then also my colleague at Tribeca Trade Group, Pat, puts out stocks to watch, which I also put out stocks to watch outside of the newsletter in our trading room, which I do on the weekend. But this is really where it's at. This is a great review and really sets you up nice for next week. So just looking at the sectors, this is where we were last week. A little bit of a change. We have energy has been weak. I have it as an avoid or a short. Telecom actually joined that. This is just the sector GICs. So the S&P, how the S&P defines sectors. If you wanted to throw in metals and mining, those would also be below the 200-day moving average. So is it upsetting? I talked about a little bit of divergence in sectors this week. Mainly where it's happening and why the S&P looks so strong is because many of the few sectors that are breaking down, such as energy, such as steel names and gold miners, they're really small portions of the S&P. They only make up, we're talking about combined between all the sectors that are below the 200-day moving average, telecom, energy, and those metals names. It's basically about 10% of the S&P. So that's why the S&P almost broke to a 52-week high on Friday, was just a hair away from it. I think how you want to use this information is, hey, you can short some securities right now because we've got a couple of them that are really breaking below the 200-day moving average, and it's a good thing hence again a good thing this has been the theme of the video. It's a good thing that these are really small portions of the overall market. So some tiny areas of the market are breaking down. The biggest one being energy, which is 7% of the S&P. Again, energy is not a big portion of the small caps. It's less than 3% of the IWM of small caps, so you really don't have to watch for it there too much. Why I do go through this exercise every week is just to kind of see what's under the hood and see what the market breadth looks like, see what's trending up and what's trending down. And obviously we've got more sectors that are in that are very strong and are trending up, that are above all the major moving averages. Industrials, materials, healthcare, tech, consumer discretionary. These are really the strong areas of the market that are continuing to break out and make 52-week highs. And again, big portions of the S&P. I would also be watching financials. They're also just slightly below the 50-day. It could basically take one day, and financials will join all the other strong sectors. I also don't have pictured semis in here. The semiconductors. Even though AMD really got taken to the woodshed last week, you look at the SMH ETF, and sorry, this is on the 1 hour, but this is still super strong. We talked about this a couple weeks ago, how this was a great buying opportunity once we reclaimed the 50-day moving average, and it sure was. So that was a trade that we talked about last couple weeks, but semi's still very strong, sitting above value and right at a 52-week high. So that is just a quick sector review, and again, not much different than last week, other than some of the strong sectors just kind of going back and forth between which one is the leader. Every week it seems to be a different one. Either it's consumer discretionary, tech. You now see industrials on the top of the list, which were also strong last week. Performance last week, which I think is always good to review and say what areas were strong and what was weak, because it may set up for a weekly trade, which I'm going to be talking about away from this video, but in the Tribeca trade room is something that you want to give a shot at this week. The other thing noticeable is this again is just looking at, we had some areas that were up 2%. We had a lot of areas that were fell apart, such as telecom, steel, the areas that we already talked about. But look at the international areas and how much they outperformed. Specifically, what I talked about in yesterday's video, which is all Europe. Greece, which I've sent out charts on the Greek ETF, really breaking out at this point, was up 10.5%. So this happened really quickly. I sent this chart out about a week ago. About a week and a half ago, and you draw into a weekly chart, you could see what this thing has done. I sent this out right around here saying, hey, this thing is breaking above recent resistance, and now it's 947. So up 10%. If you get any type of check back, keep these on your radar. So if you miss this initial move here in the Greek ETF, look at the 5-year chart, and then I'll tell you that this could have a lot more upside to go, especially with what we've seen so far in EZU. This is again a 5-year chart. So, just looking at the last year, this thing has really moved and has gotten extended, and is now into resistance, basically. We're basically in EZU right where we were back in 2014. Same thing with FEZ, which is just straight Euro stocks. Same thing with European financials. Same thing with Germany. Same thing with France. I mean, these things have all gotten back to the 2014 highs. It looks like France is even above the 2014 level. So, some of these areas have really gotten a little bit extended, and I think at this point you want to wait for some of the overbought levels to burn off a bit, maybe a recheck back to a 50-day moving average. I think that's really what you want to watch, as well as some areas that just haven't gone yet, which I'm going to get to in just a second. ETF fund flows, again, I'm not going to spend a lot of time here because I shot a video yesterday that talked about all of this, but I mean, $2.1 billion going into Europe, that's the most I've ever seen. I think that's record inflows. I have to go back and check in Bloomberg, but I'm pretty sure that's record inflows. And again, if this is the first time you're watching my video, this is something that we've been talking about for the last 2 months because there was basically no inflows at all in 2000 and 2016. There was for the first 3 quarters of 2016, there was outflows in Europe. That tapered off in the last quarter of 2016, and then we started to see inflows, money start to return in the last 2 months. I'm just looking at, so again, the major theme last week was money coming out of U.S. and into international. Besides Europe, into developed markets, which again is also Europe and Japan, and then also into emerging markets, which has been a theme of the last 6 months or so. You could see that SPY was chiefly responsible for all the outflows in U.S. equities. There was $7.8 billion of outflows. Sometimes SPY will do that. SPY is the largest ETF, so it can really whip the overall numbers around quite a bit. So, being that it is the largest ETF, sometimes you will see this happen, which is $7.8 billion coming out of this one. There was also a little bit of money that came out of small caps and mid caps last week. And also what you see here is high yield bonds. This typically happens when oil is weak. You start to see a lot of running for the exits. So, you'll have to keep an eye. Well, now, unfortunately, I think you have to look at oil every day because it affects so many different things, such as high yield bonds. On the inflow side, there was other S&P funds that actually saw inflows. So SPY saw the big outflow, but there were small inflows into IVV and VOO, also small inflows into the Qs. Actually, not so small, 735 million. You can see emerging markets, $750 million going into VWO. There's also a decent inflow going into IEMG, which was not on the top list, but a little bit further down. EFA also gathering $629 million. All right, so a couple things that I wanted to, charts of the week that I think are interesting, possible trades that you could take advantage of for next week. 2 things that I noticed. I was talking a lot about the US dollar being on the 200-day moving average last week. Well, it broke at the end of last week. It was holding in there for a little while, and it broke at the end of last week. So I think you really want to pay attention to the US dollar, see if it continues to go further down below that 200-day moving average. And then if you look at the euro, it's kind of doing the opposite thing. It paused for a couple days, for basically a week, right above the 200-day moving average. I like a long here, especially if you go out further. This is just a 1-year chart. But I think once you go out a little bit further, it puts things in perspective. And you could see that, if it could continue to climb, probably hit some resistance about 110. But the long, you could be long versus that 200-day moving average, and basically say, hey, that's my level. I'm going to be long. If it breaks back below, you're stopped out. But I think a really easy setup with it just above the 200-day moving average. If it breaks below, what are you going to lose? A dollar 50? It's not that big of a deal. So speaking of that, I wanted to talk about, I always wanted, do you want to talk about losers as well and what you've learned or what you can learn from losers and not just winners? Because nobody has all winners. It's just the best traders out there. Nobody has all winners. I know on Twitter, everybody likes to talk about winners more than they do losers. But, I think this is a really good example of how I use my trading and how you can make trading simple for you. You don't necessarily. I think a lot of traders make trading too complicated. So GLD, this was a trade that I was watching the gold chart. I watched it break the 200-day moving average, and I was sitting in it, and I was like. Or I was sitting watching the chart and I was like, wow, gold is breaking above the 200-day moving average. I'm not in it. I kind of missed out on this break. Once it came back in, I said, okay, it's rechecking back to the 200-day moving average. Let me try it. So I tried this not last Friday, but the Friday before. I went long GLD, and I defined my stop on entry. I said, if this thing doesn't hold the 200-day moving average, I'm out. So I set a 1.5 ATR below the 200-day moving average, and that's my level. That's my level in the sand for me to get out. And that basically happened on towards the end of last week. So I got out of the GLD position for a small loss, and that's it. I know some traders, they beginner traders, they have a problem with admitting that they're wrong, and they say, hey, I went long gold. I want gold to go up. You really have to put your confidence in your trading system, not in your individual pick. I see beginner traders make this mistake over and over. They're like, no, it's going up. I think the economy is doing this and that. All you basically have to watch is price. Price will tell you, and I'm going to give you another example of that in 2 seconds, but you know, go long versus a particular signal, and then have your stop defined on entry. Make it very unemotional for yourself. And again, one of my favorite phrases is small losers equal small problems. Some of the best traders out there, they let their winners run, and they get out of their losers very quickly. And they have a lot of small losers. You don't want any big losers. So this was easy. This was simple. Especially right around that 200-day moving average. Hey, if it goes higher, so be it. I caught it right on my signal. If it breaks below, get out of it. What's the worst thing that could happen? If it reclaims the 200, since I don't have a position anymore in GLD and cash, if it moves back above the 200-day moving average, I can get right back in. That's a new signal, and it's basically about what, a couple dollars away. So I'm not missing out on anything, and we'll see what it does now. So we'll just kind of wait and see if it goes back above the 200-day moving average. I'll get back in, but right now I've got no position in GLD cash, and that's just a very easy way to kind of think about trading and not be anchored to what your beliefs are. All right, so spent a lot of time in that one. The couple charts last week areas that really broke down were metals and mining and steel names. If you look at this in terms of the 200-day moving average, first of all, look at all the fund flows that have happened over the last, much more than the last couple of years. But if we draw into a 1-year chart, because I'm still at a 5-year chart, you can see that we've got a break below the 200-day moving average. Also, XME again is metals and mining. There's a lot of steel and gold miners and other miners that are in XME. If you look at SLX, which is the steel ETF, you could see that also breaking, just barely broke below the 200-day moving average. However, if you look at the weekly chart, so I think both of these are avoids. I wouldn't want to short these right now, and the reason being is that if we go back to my newsletter, you've got some really nice support. If you look at the weekly chart using the yearly value areas, you get some really strong support right at $28, which is where we found support on Friday of last week. So if it breaks below 28, you get a firm close into value. It could be a short. So I don't really know if it's going to be. Let me just finish my thought, and then I'll finish. But so right now, I think you kind of sit on your hands. If it breaks into below 28, firmly into there, I think it's a good short. If this next week, if this support holds, then watch that 200-day moving average and see if it reclaims it, and that could be a nice long setup. Same thing with SLX. It found support right at the on the weekly chart, right into this whole yearly value area, which is again for all of 2017, which is really big major support. So if it holds 36 and it retakes the 200-day moving average, you got a nice long there. If it breaks below into the value area, you got a nice chance for a short there as well. So for now, sitting on my hands, we'll see if it either reclaims the 200 or breaks into that yearly value area. So I think some must-watch areas considering where these are right now. And then I would be, without, this is the chart section for the week, without showing any European charts, I think would be a disservice. So, looking at EUFN, it is overbought. Most of the European financials are now way into overbought territory. If you look at the RSI, or if you're not familiar with it, basically anything above 70 is overbought. The EZU ETF, which is Eurozone, and the Fez ETF, which is Eurostox, both have an RSI above 80, which is really overbought. The EUFN, which is European financials, have 79 RSI. So I think this is a great area to take profits. I've been long FEZ for the last couple months. So I took profits on this on Friday, and we'll wait to see if these kind of cool off a little bit and check back to some moving averages. That could be a great place to get involved in get back involved in these. I also like to go through and take a look at individual names, not just the ETFs, and see what names are starting to trend up. I actually added a Credit Suisse long on Friday. This is again a 2-year chart in Credit Suisse, and excuse me, I think it's a 3-year chart. No, 2-year chart. 2-year chart in Credit Suisse. Notice it's above the moving averages here. So, just like I talked about gold, you could do the same type of principle for Credit Suisse. It's now above the 50, 100, and 200-day moving average. So I'm long now, and I know where my stop is going to be. That's going to be right below the 50-day moving average. Easy. If it gets below there, I'm out. But I'll sit and hopefully we'll let a winner ride, and hopefully this will start to clear this area. If you go to the 5-year chart, you could see again, which is also why I'm interested in this, because if it starts to reclaim some of this down move like we've seen in other European areas, specifically all those ETFs I just brought up, you could have a lot of upside here. But first things first, just into that position on Friday, need to see it take out this resistance area first. What else? The last one. So last one. So this one's an interesting one. If someone even asked you, or because they don't talk about this, what's the best performing country year to date? I don't think Poland would be on the top of your list. Maybe you would have said India. Maybe you would have said some of those European areas, some maybe emerging markets. But Poland is up 33%. And nobody's talking about this. I don't hear anybody talking about this on CNBC, on Bloomberg, but up 33%. We caught this. If you look on my Twitter page and search by my name in EPOL, you'll see that I was talking about this back in December and January. And really what caught my attention and why I follow fund flows is because take a look at these green bars. That was money going into the Poland ETF right when it broke the 200-day moving average. And since then, it hasn't really turned back from there. But again, really backs up why I follow or follow fund flow, ETF fund flows on a daily basis, because I find things. I find ideas, and I find where people are putting money where they haven't before. And you can certainly see those green bars, which indicate that those were really strong inflows. You could also see, a lot of times the fund flows coincide with the volume. Look at the volume that happened back in October. So somebody went long, maybe they sat through a little bit of pain as it dipped down, but then you see more buying. and you see more volume here as well. So somebody really started to go long in the fall of last year and then kind of added to it right in December. So really, really long. Do I know anything about the Polish government or Polish stocks? Absolutely no. Absolutely not. But basically, all you had to do was kind of clear your mind of your clear your mind and not think about what's happening here, and basically just go long versus a stop. So in this sense, a break to the upside on the 200-day moving average, a stop below it, and you would have rode a really nice winner that we called that months ago. So there you go. That's this. That's the newsletter video for the weekend. And please visit Tribeca Trade Group. We do this analysis all day, every day. This is what we do. You could be a part of our Slack trading room where we post information all day long. And our trading room, it's all about teamwork. It's all about making profits together, helping each other. So if you're into teamwork and if you're into really a trading desk feel, an institutional trading desk feel, where you all want to work together, call out ideas, and make money together, then the Tribeca Trade Group room is something that you want to check out. Again, visit us at tribecatradegroup.com. You could use coupon code TTG to get half off your first month. Check it out. Thanks for watching.